about yeah, wealth of knowledge, and yeah, I hope you'll enjoy the next sort of 55 minutes or so. So Penny, ready for first question?
Yes, ready to go.
Okay, so for someone who is completely new to investing, a bit like myself, where would you advise them to begin, and what do they really need to know before they start?
Okay, very good. So I think if you are at the lucky stage of actually having some money to invest, that's excellent. So you've done some things right, at least to actually get some money in the bank and make it available to yourself first to consider what to invest. But I think before you kind of venture into the journey of putting your money to work for you rather than you working for money, there's a bit of a kind of step back that you have to take, which is to consider, are you a good money manager and do you know your numbers? Because, you know, investing is quite a risky game because there's, you know, you'll find there's millions and millions of different opportunities for your money to go somewhere and hopefully to give you a return. But there's also millions of places that your money could go and you'll never see it again. So getting hold, you know, having the mindset of actually being a very good money manager is really important, is really the important thing to get right first. And, you know, what the hell does that mean? So I've put some ideas together in a slideshow, which I can also make available to you. But, you know, some of the first things to consider is, are you aware of what your money situation is? If you were to, could you sit down today and actually look at all of the expenses that you incur on a monthly basis? Do you know what your income is on a monthly basis? Are you in debt, and by how much? Because it's often a fact that people will spend about 500 to £1,000 more per month than actually they have coming in. And that often leads everyone into a huge debt problem. So it's really, really important before you start thinking about investing, actually, do you know your numbers? Do you know your income? Do you know your expenses? And do you know what your credit card debt is? And can you manage that on a monthly basis? I.e., can you make sure that you pay it off? After you've met your, you know, your expenses, how much money do you have on a monthly basis to invest? Because it is really important to think about having regular monies being put aside for yourself if you're going to create an investing future. Because at the moment, most people give up their time for money. That's essentially what you do. You provide a service or you go and work for another company, and you're hoping that you know you're going to have enough income that you can meet all of your expenses, but also being able to put aside some money for your future. And I learned a long time ago something called, well, actually, it was when I first started working in finance, and I can't remember who told me this, but they said, if you're working, one of the first things you need to do is you need to create a drop dead fund. And I thought, what the hell is a drop dead fund? Well, the drop dead fund, particularly in the finance industry, is something that people recognize is needed because sometimes you get some really terrible managers and sometimes you get great managers. And sometimes you get a great working situation, sometimes you get a bad situation. And so you need to be able to have enough money stashed away that if something goes terribly wrong, you can turn around to your boss and say, I'm out of here, thanks very much, I'm going. And in order to be able to do that, you need at least 6 months money put aside. So that's the first thing I would say before you start thinking about seriously investing. Have you got a kind of reserve fund of about 6 months money so that that's your fallback position, that's your savings, so that you have got some sort of mental freedom about how you're going to spend your time and what you're doing. So that's the sort of first thing. And so in order to be able to create that, you need to have some money discipline. So do you have the discipline to say, well, actually, I am going to, and these are some of the suggestions that I would always make, is you pay yourself first. So I think I mentioned this last time to Kate, and she thought that was an interesting concept, i.e., my recommendation is that you pay yourself at least 10% of your money and you put it away and you keep that for yourself. You do not spend it. You don't see it as a fund that you can go and spend, on your clothes or your face, or makeup or anything like that, because the moment you get money that you then pay out, it's not yours. So creating a reserve fund for yourself, having 6 months money, and having a fund that is really savings for you and your future, that's really where I think you begin.
Okay.
So that was a long-winded explanation, wasn't it?
No, that was good. And that 6-month plan is ideal. If people are able to get to that stage where you can have that sort of backup plan, then that is great. But if you are not able to sort of have that 6 months stability, but you still want to begin investing, am I right in thinking that actually you can begin with as little as £25? Is that correct?
Yes, you've got a good memory. I mentioned last week that actually one of the cheapest and things that you can do is actually invest in a what is it? It's a government. Is it not promotion fund? What is it? It's a pen. Oh dear, I've forgotten the term now. It's a £25 investment that you give to the government, and in return, they will give you a chance to win some money. It's like a government lottery fund. that you could get some money. You can get a gift as a result. But that's not really. I wouldn't say that was a proper investment. No. So it's not a bond, Jules. Thanks for that. It's a oh gosh, it's what everyone used to talk about. It's like a it starts with a P, and the word has just gone out of my head. A what?
Premium bond.
Premium bond. That's exactly right. Yes, it's the premium bond. So for £25, you can buy one premium bond, and that number goes into the lottery or into a chance to win some other some prizes. However, one of the safest and easiest ways, well, before we get to investments, again, it's almost like there's quite a lot of hurdles to kind of go over. In order to, you can just take your money and give it to the government, and you can buy a government bond. And government bonds are called gilts, and they can be very short-term bonds. So you loan the government, like 1 year. For 1 year, you can loan the government a certain amount of money. I think I'm not sure what the minimum amount is for a gilt. It might be £500. So if you had £500, you could loan it to the UK government, and in a year's time, you get maybe all of your money back. That's the guarantee. That's the risk element, and then you'll get maybe 1.5% if you're lucky. It's not a lot of money. So when you're talking about bonds, it's a straight debt instruments. You lend it for a certain period of time, and then you'll get your capital back, and then you'll get a certain amount of interest. So depending on the term of an investment, you can do that. But what I like to do before talking about specific investments is to talk about tax.
Oh, sorry, Penny, I'm going to stop you there, because I'm going to come on to tax. I just wanted to go back very slightly. Okay, so ideally, we put 10% of what we're making each month into some sort of investment, and we'll talk about the different investment options shortly. And being a good money manager, that's that sounds like a very obvious thing to say, but for so many of us, really knowing our facts and figures and what's coming in and going out and stuff, I know that's something that I could be more thorough with. So that's again really good advice. And having that 6 month backup plan ideally. That also, I think that really resonates with a lot of people. It would be nice to have that there as a kind of safety net. As women, we often have kind of, nursery or school fees, or we're paying for family holidays, or, basic necessities of everyday family life. So it isn't always possible to have maybe a large pot of money. But should we be thinking about investment monthly, annually, kind of at the end of a tax year if you've got a little bit left over? What's your advice in that situation?
Well, I think monthly is preferred because, and automated is even better. So, and this is where I say pay yourself first. So when your money comes in, if your money comes in on the 25th of the month, on the 25th of the month, it should get a certain proportion of that should go out to your savings account. Now, I wouldn't necessarily put it into a savings account. And this is where I say, well, a tax wrapper like an ISA is the best place to put it. So you could actually replicate, you could put your drop dead fund or your reserve fund, you could make that an ISA. And an ISA, it can be a cash ISA or an equities ISA, and you automate it so that each month a certain proportion of your income is going to go to the ISA. So if you can make it 10% as a starter, do that. If not, make it 5%, or make it 3%, make it 1%. But it's more about building in the habits, building in the mindset that you are going to be managing the money on an active basis. And the thing is, if you get it out of your account into your savings, then you won't spend it that month. And so that's the sort of like little tricks that we have to play with our own minds. If we don't have it, we're not going to spend it. So we just put it away. And if you get more income in the month, then again, have the attitude that says, so 10% of everything I'm going to bring in, I'm going to put away into the ISA. So let's say you do a second job, or you have an unexpected windfall, you get a new client that gives you some extra money that you hadn't planned for. You can look at what comes in and say, right, at least 10% of everything comes in, I'm going to put away. So get that kind of practice so that if you put it into your ISA, then you have choices about where to invest.
Sure. Okay. Just so with that 10%, is part of that the money that you're putting into your pension, or is that an excess on top?
There's a big difference in my mind between pension money and ISA money. Pension money, if you put it into a pension, you can't actually draw it out until you're 55. So that is a very serious thing to be doing, and obviously we all need to do that, and the younger you start, the better it is for you. So definitely, but you'll need to know that you won't be able to access that money until you're 55 or later. So initially, as part of building the practice of becoming a good money manager, paying yourself first, paying at least 10%, put it into an ISA, because if an emergency occurs, you can actually draw that money out.
Okay, understood. So obviously you can invest in a pension, there's lots of other, you can invest in property, there's lots of other ways that you can invest. But can you talk to us a little bit other than pension and property about the options that there are, and if you can do it yourself or if you need some help with this, and what would be your advice either way, and what are your experiences on that, whether it's with a financial advisor or educating yourself?
Right. Okay. So I've got a question here from Jules. So I think I'll answer that here because it's particular to the rest of the session here. She says, are there particular ISAs you recommend? And I say, I have to say no. This is my financial disclaimer. I'm not an IFA. I'm not authorized by the FCA to give investment advice. So I'm not actually recommending anything specifically about what you should or shouldn't do. I'm just giving you more broader information about the concept of ISAs, but I can talk more about what that looks like I prepared a slideshow. So if I can just share my screen, and then I can sort of just give you some information from here. So I've just talked about that. Can you see this?
Yep.
You can. All right, so let me just. Okay. Yeah. So this is what I've just been saying, you know, about telling the truth about money, really sitting down and looking at your numbers, and begin by saving. So I won't actually talk about that right now. Okay, so investing options. Okay, so one of the things that is really important to know is that actually you have a lot more choice about investments than you think you have. And that is because if the aim of your investments is actually to make you financially independent or financially free, there's probably some things that you can be doing right now in your life, in your work, that you can be creating some assets that are going to be working for you. Because when we start out, we are often thinking, and our culture really trains us to think that actually you have to work for your money. But an investor thinks, no, I'm not going to work for money. I'm going to have my money work for me. And one of the ways that you can get money to work for you is that you can create assets that work for you to generate money. And that is, very in some simple terms, you can create some IP, whether it's a music recording. Kate has a beautiful voice, by the way. I heard her the other day. It's fantastic. So if you want a real uplift, go to her Facebook page and find her recording. So she can easily record some music and actually sell that. And actually, that is something that you create once, and then it's forever available. So you can create IP with photos, audios, videos. You know, Jules is a marketeer. She has already is creating some online programs. So once you create something like this, you can put it online, and it will work for you forever. So that's one block of things that you can be doing. The other thing that you can do is property. You can invest in property, and you can rent in tenants, and there's rent to tenants. There's loads and loads of different types of properties that you can invest in, and lots of different ways you can do it. There's commercial property, and you could even invest in private businesses. So that's some of the investing options before you even get to think about you know, stocks and shares. So when you start looking at monetary investments, this is where I would recommend, if you can get to a situation where you're setting up an ISA, set one up each year. And if you're really well off, you can set one up for each of your children and build, you know, their future. There are things like SIPs or other pension funds. So your pension, if you're employed by someone else, it's really important that you make as much investment as you can. And if you can get your company to match your investments into your pension fund, because you are building a long-term asset there. But ISAs and SIPs are both tax wrappers that benefit you long-term, because it means that anything that you've invested inside of an ISA, all of the capital gains, all of the dividends, all of the income that you get within those wrappers means you don't pay tax on them. Now that's really important. That means you don't pay income tax, because if you got that money outside of that, it could be considered income tax. Or if you've got like, you know, for dividends are considered as income tax. Or if you get capital growth, then you have to pay capital gains tax. Whereas if they grow, if your assets grow inside of ISAs or SIPs, then they're tax-free. So your investment options are UK government bonds, which are gilts, and also other bonds, corporate bonds, and they can be in time length anywhere between 1 year to 30 years. That's normally the normal term of UK government bonds. And also the corporate bonds tend to be much shorter time frame. Between 1 year and 10 years is often the sort of the time frame for corporate bonds or company bonds. And then we're looking at your options in buying equities. And I can't remember how many thousands of governments, UK companies are listed on the FTSE or in other exchanges around the world, but there must be hundreds of thousands of companies, so that you've got options. By being in the UK, you can invest not only UK government in companies, but multinational companies as well, American companies, German companies, emerging market companies. So you can make choices about the individual companies, or you can invest in funds which are managed by fund companies, and they decide where to invest. And so they have funds like, sorry, I'm going to stop sharing here because it's ever so boring. I was reading a fund manager's sort of brochure yesterday, and they have a variety of different funds. So they'll invest in UK stocks, they'll invest in American stocks, they'll invest in Asia Pacific, they'll invest in China, they'll invest in emerging markets, and those fund managers make the choices about what are the best companies, and then so you're putting money into their funds, and then they make the choices. And
that's great, Penny. So if you were to approach a financial advisor or a fund manager, they would organize where your money went to hopefully receive the best return on it possible. So if I don't want to use a financial advisor, you know, if we've got to this point and I've said, okay, I've got a little bit of money and this is what I want to do and I'm going to move forward, how do I do that? What do I need? What can I do to educate myself? What do I need in my toolkit to be able to make that next step if I don't want to use a financial advisor?
Yeah, right. So there's value. One of the things that I've learned, because I've been in the financial world for quite a long time, and one of the things that you recognize is there is so much that you could learn. There's so much you could understand and know about. So it's about finding routes to information. And an IFA is normally has got a lot of information, but it's information about their products. So often I've been to network events, and you've probably been to lots of networking events where there'll be a St. James's Place IFA, and he's there and he's going to tell you about all of the wonderful funds that St. James's Place has. And then there's financial advisors that are related or connected to a fund management group, and then there's independent financial advisors. And independent financial advisors are differently educated, and so they are not tied, that's what they call it, they're not tied to a particular group, and then they will give you more information around the marketplace, and they'll be much more interested about your personal financial situation, and they'll ask lots of other questions as well about your future and your risk profile and things like that will actually start giving you information about, well, actually I haven't considered about this and I ought to think about that, and what is my current situation in terms of, can I afford to be risky with some money, can I afford to lose any money, or do I have to go for a very, very safe investment? So that's the value of an IFA. If you don't want to go that route, then I would strongly recommend that you get on a path of quite serious study. And the best route, the best place I found for studying finance is the Financial Times. It's a bit of an investment in terms of cost of money for a newspaper. It's £4 for a particular weekend if you buy the weekend FT, which is quite a good source. You get a lot of information during that on that weekend about all the funds and where they're performing, And then you get some really interesting articles from people who know their stuff about pensions and ISAs and SIPs. And what I find the most useful is people who are managing their own assets and their own funds, and then they'll tell you about what they've invested in and how they've performed and everything like that. And I find that very, very helpful.
Okay, that's brilliant. Yeah, I mean, we've all grown up and all know about the Financial Times. Never once have I ever bought it in my life, but I will be buying it. And ever since you first mentioned that to me last week, I actually did get a copy last weekend, so I will be doing that moving forward. I think £4 is quite a good investment if it helps you to make those sorts of decisions. But that's great. I also wanted to add, you know, that people might be aware of this, but there are plenty of social media, almost like money influencers, I think they're called now. So there's plenty of guidance, free guidance and help on the web and on social media channels like Instagram, and it's pretty easy to digest. It's often kind of colorful, and yeah, there's just a wealth of information now, and that's something that I am trying to make the most of. It's free education, really.
Sure. Yeah,
So,
I mean, the other thing that if you want to educate yourself, one of the things that I've done, and actually before we go there, Jules, do you want to say what you've written up on the chat?
I know, I was just mentioning the fact that there's always St James's Place IFA and a utility warehouse rep at networking events.
Yes, yeah, and they can be helpful and useful as well.
They can be. No, it was, but it does always make me laugh. I have walked into events and tried to spot them before.
Right. Yes.
There is often one of each, and yeah, that's true. I actually have spoken to St James's Place financial advisor, and she's female, and she's been extremely helpful in regards to my pension and things. And one of the things that Penny mentioned to me was, you know, if you do choose to use someone to help you, is again, you know, you are paying for an education basically there, because soak up as much information and knowledge as you can from them. Everything they're telling you, get it written down, and make sure you're learning. So if you do choose to pay and you do choose to seek advice that is from a financial advisor, make sure you're taking all that on board, so that next time you don't need to, because you've learnt those things. If that makes sense. So
good. One more thing, just to answer the last question, Kate, is one of the things that I found the most useful in terms of giving me the confidence to decide about what to invest in, because like you, when I started out, I trusted other people. So I trusted IFAs, I trusted the wealth management firm with my money. In fact, I trusted 2 wealth management firms with my money, and at the end of the day, I was always unsatisfied and by how much they had. Whether I was dissatisfied on 2 counts. One is they didn't manage the risk well. So when the markets tanked, my investments tanked as well. So I was losing money. And then the other side of it is, like, when the markets were going well, they weren't going as well. So they weren't, taking the ride up, but they were taking the ride down. So it always felt like they didn't know what they were doing so well. And so at the end, I took control of my own money. But in order to make myself confident that I could actually manage the money that I had accumulated, because it was like 30 years worth of investments, that I could manage it myself. And so I was trained by in fact two companies that I learned with, but one which I found very, very helpful is something called the Online Trading Academy, and they're based in St Albans, and they do have a basics trading class, which is like a week's worth of work. Like, can you imagine? 9 until 6 every day for 7 days. And you learn an online platform, how to use it. You learn about how to read the market trends. You learn to read about companies. You learn to know how to get in and out of your investments. And I found that really, really helpful. So now I have my own other educational platform where I can see how the market is performing on a daily basis. So I can open up my platform on the morning and see, I can see what my investments are. I can see what has happened to the markets overnight and during the day, and I can see live prices. Now that is where you want to get to, but don't expect to get there too soon.
Yeah, okay, that's really helpful. Thank you. So we've talked about, obviously, when you recognize that maybe your investments aren't performing in the way that you want them to, or they are, and that's great. But that's all to do with risk level, or to a certain extent to do with risk level. So how can I best inform myself of the risk, and what could you just talk to us a little bit more about risk levels? And last time you mentioned about investing in government, shell, and non-stock market companies being low, high, medium. And maybe if you could just go into a little bit more.
Sure. Yeah. So yeah, you've lived in the world, right? And in our lifetime, in the last 11 years, we have seen two major downturns. We saw the economic downturn happen in 2008, 2009, and then we experienced the pandemic. And in both scenarios, there were huge ramifications that happened in the stock market and in companies. So the first thing to say about risk is that risk in the financial markets is a reflection of what is actually going on in the real world. So in the real world, when a bank doesn't have money to pay back its investors, then the bank is in trouble. And what happened in the economic downturn, really big banks like Lehman Brothers failed. They just literally ran out of money. They had more debt than they could actually cover, and they went out of business. In the downturn, lots of businesses, and we as business people also experienced, suddenly, we had orders, we had businesses to run, and we thought were good, and then suddenly our orders disappeared, businesses changed, and so there was a downturn. For us experiencing that, and possibly for you. But then on the other hand, what's happening in the real world also gives businesses opportunities. And so because of the new demands that were created by the pandemic, for example, suddenly we had new opportunities, we had new lines of work that we could create. So when you are a private company and you are a small company, the risk that you face of surviving long term, thriving and growing is much greater than a company that's been going for 30 years and is doing okay. So for example, like BP or ExxonMobil or Amazon, because they have been going for a long time, they are not so subject to the vagaries of the ups and downs of the economy. And so therefore they become less risky assets. So risk is always a factor of size, experience, and trust that company has created in the marketplace. So the largest companies that have created the most assets in terms of customers and trustworthiness of belief of those customers continuing to buy their products will mean that they are a less risky asset. So for example, Apple is a very low risk asset because it has got trillions of people buying its products. It's had them buying those products for a long time, and so they are less risky. So the FTSE 100 is the top 100 largest companies in the UK. The S&P 500 are the 500 largest companies that listed on the stock markets in the US. In the US. So different stock exchanges have less risky assets because they're very large, they've got sustained businesses, and then you've got more risky assets which tend to be younger and smaller. So that's just a very easy way to put it.
Yeah, that makes perfect sense. And in terms of government as well?
Yeah, so there are rating agencies called Moody's and S&P, which rate governments. So around the world, there used to be lots of AAA governments, and that's the best rating of any kind of government. And the UK used to be a AAA rated government. Unfortunately, it's now downgraded to a AA+.
Still pretty solid.
It's still pretty solid. So there are different ratings, and this is how governments you can consider are highly rated or less rated. And the less rating, they're going to pay more money. So you can buy a Venezuelan bond and you get a lot of money. You'll get a lot of interest. I don't even know what that interest is, but it's quite high because it's a very high risk country.
Yeah. So the higher the risk, the more likely you're going to have a great payout, but you also risk that it could go the other way.
You got it.
Okay, so Debbie asked the question in regards to the online training academy. Who would you feel that would be suitable for, Penny?
I think that would be suitable if you've got, I think if you've got something like about £40,000, 30 to £40,000 as a cash fund that you need to be managing yourself. Maybe you've given it to asset managers before that they've looked after for you and that they're not doing so well. But I think about £40,000-50,000, it makes it then financially viable to go and learn about how to. I mean, they're really focused on trading, but I use it really to inform my investing. And there's a difference, because trading is people who want to trade the markets, go in and out of the markets daily, weekly, 2 or 3 weeks time. Whereas investors tend to buy and hold their investments for maybe 3 months, 6 months to a year. But that, I would say, those are investors. So if you've got about that kind of amount of money and you're looking at how to take care of it and grow it, then do that. But it's not something that you can do quickly. You have to try and make mistakes and learn from, and make mistakes and learn from. So
sure,
it's one of those high risky strategies.
That answer your question, Debbie? Thanks. Okay, fab.
Yeah, it does. Thank you.
Okay, brilliant. Yeah. Good. So the next question is in regards to how long do I need to, obviously you said about trading stocks and shares, you know, trading is very different to investment. If I'm investing, how long do I need to be investing for? And could you just give us a little bit more idea and sort of how does that affect risk level? If you know that you're going to be investing maybe 5-10 years before you're going to need, you know, want to take that money out to buy a property or whatever it is that you choose to use it for, how does that work with assessing what risk level to take?
Okay. So one of the books I would strongly recommend anyone who's here today reads is something called The Cash Flow Quadrant by a guy called Robert Kiyosaki. And one of the things that he says is that, you know, there's 3 different mindsets of people when you're talking about money, how people earn their money. Some people are happy to go to work for somebody else, and they are willing to give up their time for money. Other people want to work for themselves, so they're normally talented people with some skill sets, and you know, are either lawyers or accountants or singers, and they're using their talents and they're selling their talent for money, so they have an income. And then you have business owners who are creating a business that they are using other people's time and money for, to build a system and a business. And all of them, you can earn money through any of those kind of mindsets and through any kind of route. But if you're successful in any of them or in all of them, you're going to end up with money. And so hopefully that money will make you an investor. So I would recommend that you think you're going to be an investor for life. The issue is, what are your choices of investment? So when you're young, you may be investing in ISAs. At a certain time, you might want to withdraw some of that money and invest in property, whether it's your own or other sort of commercial property, or you're investing in assets that you are going to be creating that are going to give you an income. So for example, as I said before, if you want to create IP, you want to create something online, that's also an investment. So it's really down to your whole investment strategy, thinking about your whole life. So you're always going to be an investor. The choice is, what are you going to be investing in at different times? So an ISA is a nice place to have lots of cash and or short-term investments that you can then sell off and then get out. But then you can choose a different investment to put it in. So like a home or property or other things.
Okay, sure. Helen just wrote on the chat, so sorry if any of this is slightly to beginner level for you, Helen, because it sounds like you know quite a bit yourself. So Helen says she's invested in ISAs, premium bonds, property and private pensions, and also have an income from a holiday home. Now I'd like to invest in something a bit different, like art or wine. Any advice on this?
Yeah, well, I think the thing I would say is you can invest in anything as long as you're knowledgeable about it. So become knowledgeable in the wine industry and in different wines. And because if you're going to do an investment, you need to know what you can buy something for and what you can sell for. My neighbor is an investor in wines, and he and his wife, before the lockdown, used to make at least 2 trips to France every year. And they would come back with stacks of boxes of wines, which they then would hold and then would sell after a period of time. And so they got to know where was the auction places, they got to know what was able to be sold, what was able to be purchased at what levels, and what people would buy it for. So that's what they did. They had a particular strategy. So that is just saying, find out about the actual instrument. My brother is an investor in art, and he tried to persuade me to buy a Banksy about 15 years ago, and I ignored him. Unfortunately, the thing that he told me to buy, which he bought with my brother, is now worth £20,000. I think it was worth £1,000 at the time, and he's now worth £20,000. He recently bought something from an art show. I think it cost him £100, and it's now it's being sold on, he bought it last month, and it's now on the internet for £450. So it's knowing, find something that you're interested in, find something that you're passionate about, and then know about it, get inside it, and learn about it, and then you can buy and sell it. Because in some respects, investing is about both buying and it's also about selling, because without the sales side, you don't make the money. So does that help, Helen? I'd love to hear from you.
Yeah, definitely. Thank you. I'm definitely an expert in drinking wine. I'm not sure about investing in it.
Sorry, I didn't hear it. You're very faint there.
Hang on a second.
Helen said she's definitely, sorry, she said she's definitely an expert in the drinking of the wine, but not so sure.
Yeah, finding out where is it, what is the what wines do other people want to drink, and where can you go and get it? Can you get it can you go to a particular part of the Champagne region and get X number of bottles from the from the vintner who's actually making it, then you're basically getting something at the cheapest end, and then you have room to make it to sell it elsewhere.
But Penny, you also mentioned last time we spoke, taking an interest, the things that you are interested in, the things that you are knowledgeable about, we're all consumers, and therefore we all know about brands and products and things. And you gave a really clear example, Fever Tree, that's something you've chosen to invest in the past because drinking gin and tonic got really popular again 5 years ago, and now there's gin festivals galore, and Fever Tree have just grown massively, haven't they, because of that trend?
Yeah, exactly. So investing can enhance the kind of the life interest that you have. You can use what you're consuming, you can use what you're interested in, like Burberry. I've always been interested in fashion, so I bought Burberry and I bought Ted Baker. So you can take what your interests are and then find those kind of companies in the marketplace and get to know them and what they're doing, and you can you then know, you have a real experience as to whether actually is this product good, does this product work in the marketplace, do my friends love it as well. So then it becomes a source of information for you as a platform for them making other choices about what to invest in. So that's the most easy and experiential way to learn about investments. It's like finding the companies that do what you love to do, and then investing in them. So for example, this morning I was looking at a company called CVS, and they are a veterinary company. Now my friend who has 3 dogs, she introduced me to this company, CVS, because that's what she's interested in. So she's interested in vets and the services they provide, and it's a really great company. It looks a very interesting company, so I'm considering buying that at the moment. I'm not recommending it to anyone, but it's just a demonstration of the kind of things that you can get interested in and find out more things about. Okay,
brilliant. Last question from me, because then I will just let anyone else who wants to speak for the last sort of 5-10 minutes or whatever. So say I have identified, I buy beauty products from this company, and that's who I want to invest in, and that might be for ethical reasons or because they champion sustainability and all those sorts of things. Another thing that I know that we've talked about in the past, of making sure that you're investing in companies that are putting your money in the right places. How do I go about doing that? Do I have to do it in stocks and shares? What if they're not listed, and that's not possible? How do I actually give my money into that company, if that makes sense?
Right. Okay. So if you know about the company and you can find out about them, there's the easiest way is if they are listed. Now, if they are listed on a major stock exchange like the UK or France or European stock exchanges, they're easy to do. You can just buy them from any online platform that that you can buy shares with. But if they're a private company, then you can't invest in them unless they have unless you know someone in the company and they are doing a funding. They're doing a funding round. So if they're a private company, and normally you have to be a specialist investor to be allowed to invest in private companies. So normally this is restricted to special venture capital firms, or venture capital firms who invest in private companies before they're listed, or they may be doing a friends and family round or something. If you know someone who knows someone, you might do a friends and family round, and then you can invest in that company. The way to do that is to contact the company directly and find out if they have a funding round or investment round coming up, in which case you might be able to do it.
Okay, thank you. That's really helpful.
Okay.
Good. So a platform like that, would that be like Nutmeg that we were talking about?
No, Nutmeg.
Not for the things that are not listed, but for the things that are listed, could you use something like Nutmeg?
Well, I've looked at on Nutmeg, and Nutmeg actually only allows you to invest. It allows you to invest in ISAs. So you can set up an ISA on Nutmeg, on the Nutmeg platform, and then you can invest in something in funds. So they have a range of funds that you can invest in, or you can invest in something called ETFs, exchange traded funds, which are another form of fund, which again are quite sort of narrowly specific, or specific to an industry or to an index or to a type of investment. So you can invest in a property fund. So Nutmeg only allows you to invest in those kind of assets. You can't invest on the exchange. In order to invest on exchange, you need to use something like II, Interactive Investor, or eToro, or Hargreaves Lansdown, or Barclays. They all have various sort of online tools that you can use to directly invest in specific companies.
Thank you.
You're welcome.
Anybody else who has a question or would like to give any sort of feedback in terms of things that have come up that we've talked about, feel free to take the floor.
Just to say, it's very interesting. So I've got some stuff with Halifax, and I've got a property, but I quite like the idea of investing in wine, if I'm honest. But yeah, so it was a really interesting discussion. Thank you.
Good.
Yeah, thank you. I really appreciated it. I found it interesting.
Good, fantastic.
Because you're an investor in property, aren't you, Debbie? I'm sure you could probably tell us a bit about that. What's that experience like for you?
Oh, I don't know what you want to know.
I mean, is the investor journey worth it? What do you think?
Oh yeah, absolutely. Because like I've been working with you, and I've been like out of work for quite some time, but the income from my property has kept me going. So it's been like a real buffer. Like it gives you a sense of security, because I used to have a business, and while I had it, I always thought this was something I could grow and build up and then sell, and my business would be my retirement. But it didn't happen, because I think a business where it's so reliant on a sole owner and their creativity, it's very, very difficult to then pass it on to somebody else. Mm. So I saw property as a way of having an asset that always would have a value for it to be something that could be sold. Yeah,
absolutely. Yeah, exactly. So you're putting your money so that your money works for you. I think that's the real value of property as well. The other thing about property is that is consistently, certainly in the UK in our lifetime, is constantly appreciating.
Yeah. Please stay like
please God.
I know, because like already you're hearing people are saying there's going to be a big crash in property soon. I don't know, interest rates will go up.
Yeah, I think they've been saying that for a long time now, and I think we're quite fortunate, based in the southeast, that it's all being close to London and all that sort of thing. I think, yeah, it might crash, but
it goes up again. I mean, that's the thing, and one of the best pieces of advice I've ever been given, actually, about investing, is that you buy at the crash and you sell when everyone's saying now's the time to get in, when it's really booming. So actually, I've done very well in the last year, because when the markets crashed in March and April last year, I bought loads of stocks. But it takes a lot of guts. So if the market crashes on property, that's when you buy.
Mm.
Don't buy property now, because you're at the high end. So you need to be buying when there's when it falls.
Absolutely. Yeah.
So thanks, Debbie. Helen, do you want to say something?
Anyone?
Can't hear you, Helen.
Helen, if you're having, okay, fine, nothing to say. That's cool.
Okay, thanks.
Okay, brilliant. I think that sort of wraps up the conversation. And one of the things that I just really want to stress is that wherever you are in your sort of financial journey, or you're learning about your investment, as you can probably tell, I'm in the early doors, but it's so helpful and so nice to be able to speak to other women. And there's nothing wrong with speaking to blokes about it, but it is also nice to just have that sort of girl power. How do you feel about this? How do you feel about this? Because there are very few women in my life that I feel that I can ask those questions of without them going, well, I don't know. And that's sort of just being in a little circle of I don't know. So I really would encourage everyone, and I'm also trying to practice what I preach, in that speaking to as many women as possible and saying, how do you feel about this? What don't you know? What do you know? And sort of bouncing off each other, because that's how we will eventually bridge the gap between that is quite drastic at the moment.
Excellent. Right, well, thank you very much, Kate, for promoting these webinars. We'll see if we'll fancy doing any more. Let us know if you think we could do any more, and what questions you may have, because these webinars have really been driven by the questions that Kate and her friends had. So if you've got some questions, let us know what they are, and comment on the Facebook page, Standing in Her Power, and hopefully we'll see you again soon.
Thank you so much, Penny, for your words of wisdom, and for making it a really interesting and enjoyable hour. Thank you. Thank you, everyone.
Thank you.
Bye.
Bye-bye.
Bye.
Bye.